Hello, Vix Trader here for Monday, December 10th, 2018. Before I post a video on today's trade on the VIX and the spiders, I thought I'd do a quick video on why markets go up and down. I made this for myself. I thought I'd share with you things I've learned over the past 20 years of trading. And along with my economic background, that's my education, and I have a degree in economics. I thought the first thing, this helps me keep things a macro view in a yearly time frame or much longer time frame, a weekly versus this is a yearly chart, weekly chart versus just a 15-minute daily time frame. I have to just step back and see what the market's doing and what message it's sending us. One of the things I learned once the first thing is that the higher you're complicated, the more complicated your system of trading is, usually the higher your rate of failure of losing money. So I try to keep things simple to a few simple rules. The first driver of the market is expansive monetary policy. That's when the Federal Reserve lowers rates or there's quantitative easing, which means they create credit. Creating credit is simply buy treasuries and give banks credit them, which they can use to lend out to the economy. The second thing is fiscal policy from Congress and the president, which is about simply lowering taxes. That's pretty simple. And why markets go down is because the Fed raises rates and they do quantitative tightening, which is what they're doing at the tune of $50 billion a month, $600 billion a year. Causes liquidity issues and the markets tend to go down. And also by raising taxes. You know, when the federal government, Congress, in this case the president, put tariffs in, that causes the markets to go down. So these policies, when they're expansive, cause the market to go up. You know, we can see that in the long term. And when they're restrictive, they can cause the markets to go down. You know, we can talk about the Alan Greenspan was raising rates here, markets started going down. Alan Greenspan started cutting rates here and kept them low for a long time. Markets went up. Ben Bernanke came into office in 2006, began increasing interest rates from 1% to 5.25%. We saw the Lehman issue. Then in January 2006, he cut rates to essentially zero. He began quantitative easing in March, and he kept that policy pretty much to the last 2 years when Janet Yellen came in, and we saw the markets go up. You know, and along with that, on the fiscal side, we saw things such as TARP come in October 2008, and there was an $800 billion spending plan in March 2009 by the Obama administration. Those are all expansive and caused markets to go up. Now we are in a cycle of markets are going to go down because the Fed is raising rates. They said they're willing to pause, but they're still going to raise rates in December. And we don't know how many rates they're going to rate increase till the next year. And they're still continuing to do quantitative tightening, 50 billion a month. And the tariffs have gone in place, and they're threatening more tariffs in 90 days, which is going to cause the markets to decline. And we can see, you know, markets are already below the January low, 260 is kind of oval chart. Or if I have a newer chart here, you'll see that it's already gone below the 267.40 monthly low right here, you know, and so is the January low right here. I'll move it up a little bit, this line, and you see the price is below it at 263.57. So when you listen to the news, once what can cause the market to go up, you gotta listen to what the Fed says, and I'm gonna avoid what the Trump administration is saying about tariffs. That's a little more complicated, but the Fed's basically saying labor market's too tight. That's their message. That simply is a euphemism, which we can translate to we need people to lose their jobs. And I'm assuming maybe their goal of unemployment right now is 3.7%. Maybe their goal is 4.7%, 1% higher. That means about 1.8 million need to lose their jobs before they want to maybe pause or lower rates or stop quantitative tightening. If their goal is 5.7%, 2% higher, then 3 million people need to lose their jobs. You know, so that's what you got to listen for. What is going to cause the market? What's going to cause for the policy to change? You know, the fundamentals to change. what's going to cause the Fed to change the policy, and what's going to cause the politicians, meaning Congress, to change their policy, not to put the tariffs in place in this situation. You know, so the technicals are simply monetary policy being expansive or restrictive, fiscal policy by Congress and the president being either expansive or restrictive through lower taxes or higher taxes. The technicals, the macro trend, you'll see that is up. That's one technical I use. The January indicator, which I talked about, the bottom line, if it's above, you really ideally want above the top line, the January high, which is right here. You saw the market rally here. January high, market rally, January high, market rally. That's what you want. We're below it, which is very bearish. Have a 5-year trend, and you'll see the 5-year trend is this green line, and it's around, in January, it should hit about $240, which is SPX, S&P 500, 2,400. And so we're above it. I'm expecting sometime either this year, in the last 2-3 weeks of the year, or next year to come down, touch this line, and find support. So that would be maybe a good buying opportunity. So potential bottoms, I use a Fibonacci retracement, from the bottom to the top, and the 23% just happens to be around 2,400, 2,350 to 2,400. What about the 5-bar moving average? What a coincidence. And if fiscal policy doesn't change and they're still going to put the tariffs in and they don't care if the market's at 2,400, so we're fine with that. Or the Federal Reserve as well, the market's, it's only at 2,400, it's only down 15%. We're cool with that, and they'll continue the same quantitative tightening, of $500 billion a month. They'll probably go down to the 38% level, which is around SPX 2000. We'll see if that scares them into changing their policy. So when you listen to the news, you just want to listen to, at what point, our question is, what will cause the Fed to change their policy? What will cause a politician to change their policy? Well, we're trying to Trump administration to go, hey, the market's down 40%, maybe we shouldn't put the tariffs in. Market's down 30%, maybe we shouldn't put the tariff. At what level are they willing to change? At what level of unemployment or what level of stock market prices are they willing to change the policy? That's what you listen for. So right now I have pretty much, although the market remains in the uptrend still, but it's at below the January low, and that's usually an indicator of bearishness. And it's above the 5-bar average, which I'm assuming policy was going to say, hey, let's bring it down here. So that's what I use, to keep my mind more on the bigger picture and not just on the day-to-day 50 minutes, 5-minute chart, trends. It gives you more of a macro look. This is good for investing, not really for trading. Trading is good. These are too big of a time frame for trading, but if you're an investor, these are the kind of charts you look at. A yearly chart, you see what price you buy at, and maybe at what month, what price on a monthly thought, what prices you could look at. Fixed Trader here. Thank you for listening. Please like the videos if you like them. Subscribe if you like as well. I appreciate you guys taking the time to check these out. Bye-bye.